Hello friends, in the series on the income tax cases, today we will discuss a case which is related to the period demonetization, that is assessment year 17-18. The main issue involved in this case is that whether assessing officer has the power to make the additions just on the basis that the assessee has deposited the cash of an amount of rupees 3.06 crores in the demonetization period, where the assessee do not have the habit of keeping the cash, and whenever the cash is generated, the assessee deposits the cash into the bank account. In this case, this was the only big reason for making the additions. The name of the case is NEERAJ CAMELLIA Private Limited versus Deputy Commissioner of Income Tax, and this case has been reported in 111 ITR Tribunal Short Notes 12, and the matter has been decided by Honorable Raipur ITAT, and the date of the judgment is 18th March 2024. The facts of the case are very interesting. This case is related to the assessment year 17-18. During the demonetization period, that is 9th November 2016 to 31st December 2016, the assessee deposited a cash of rupees 3.06 crore, and out of this 3.06 crore, 2.71 crore was in specified banking notes, that is the currency which was banned by the government. The assessee was a jeweler who was involved in diamond, jewelry and silver business. It was the plea of the assessee that the assessee has not deposited some unusual cash into the bank account. The assessee said that in the same period, which was in the preceding period in 2015, that is 9th November 2015 to 31st December 2015, the cash deposited by the assessee was 4.88 crore, and this was the one of the main grounds of the assessee. And the assessee said that due to the festival seasons, the sales of the assessee increases because the period which was covered with the demonetization, there was Diwali, and because of Diwali, the sales of gold, diamond, jewelry increases, and these were the reasons which were given by the assessee to justify the cash deposit out of the cash sales made by him during the demonetization period. But the learned assessing officer was pressing one main ground, and he was saying that from the perusal of the cash book of the assessee, it is very apparent that the assessee is not in the habit of depositing, the assessee is not in the habit of keeping the cash, and the assessee is depositing the cash as soon as the cash is generated in the books of the assessee. So this is very unusual on the part of the assessee that he has kept such a huge cash of 3.06 crore and deposited in the demonetization period. The assessing officer also relied on the media clippings, the status report on clean money, and the assessing officer also relied on the income offered by various assessees in the Income Disclosure Scheme 2016 and Pradhan Mantri Garib Kalyan Yojana scheme, in which the various assessees declared their income at the rate of 25 to 40% of the cash deposited. So the assessing officer picked this rate of 25% and made the addition of super profit into the income of the assessee by giving a relief of rupees 10 lakh for the opening cash. When this matter was before the CIT appeal, the CIT appeal also upheld the order of the assessing officer. When this matter came to the tribunal said that in the present case, the revenue has also made survey on the assessee, and in the survey also there was no affirmative found into the stock and cash of the assessee. The tribunal said that the assessing officer has made the additions on the basis of the media clippings, status reports of clean money, and the income offered by various assessees into the Income Disclosure Scheme and Pradhan Mantri Garib Kalyan Yojana scheme. So whatever the addition has been made by the learned assessing officer in the present case is clearly a perfect example of additions just made on the basis of suspicion, assumptions, presumptions, surmises and conjectures. So the tribunal said that in the present case, whatever the books of accounts have been rejected by the learned assessing officer by taking the shelter of section 145 subsection 3 is not justified, is not approved, because for rejecting the books of accounts under section 145 subsection 3, one of the two conditions should be satisfied. The first condition is that there should be dissatisfaction of the learned assessing officer regarding the correctness and completeness of the accounts of the assessee, and the second condition is that there should be failure on the part of the assessee in complying or in computing income as per the accounting system employed by the assessee. But in the present case, there was no such failure indicated by the learned assessing officer, so the addition made on the basis of surmises was not justified. At the end of this video, once again I am repeating the name of the case. The name of the case is NEERAJ CAMELLIA Limited versus Deputy Commissioner of Income Tax, and this case has been reported in 111 ITR Tribunal short notes 12, and the matter has been decided by Raipur ITAT bench, and the date of the judgment is 18th March 2024. Thank you, friends.